Hello and welcome. My name is Partho Majumdar. In this video, we will discuss the risk reversal strategy for options trading. The risk reversal strategy for options trading is utilized when the underlier is a currency. Now, this risk reversal strategy is utilized when we want to trade in the underlier within a certain range. Now, the traders who are trading in currencies, they would like to trade in currency so that the value of the currency is within a particular range. So, under this circumstance, we will utilize a risk reversal strategy. Let's go through the details of this strategy. The risk reversal strategy is basically a hedging strategy. Most of you may be understanding what is a hedging strategy, but we will discuss it for the completeness of this presentation. Now, in our daily lives, we make some savings, but we know that the savings will keep on degrading because of inflation. So what we do is that to hedge our position against the degradation of the savings, we invest in gold or property. Now we know that the gold or property prices go up as the inflation goes up. So this way, what we're doing is that we are squaring our position by the loss from one instrument that we expect by making a profit from another instrument. So this is what is hedging, where we invest in one instrument, and when we expect a loss to happen in that instrument, we buy another instrument which can offset the losses what we will make in the first instrument through the profits of the second instrument. Similarly, when we are dealing in stock market, supposing you expect the stock to go down, or the stock market as a whole to go down, you invest in gold. Normally, in historically, we have seen that the stock market and the gold prices move in opposite directions. So this way, the gold price will hedge the loss which can come from the stock market. Now, this risk reversal strategy is utilized by importers and exporters. The importers and exporters, they will be importing and exporting goods. However, to import or export goods, they have to deal in currencies. So the importers and exporters utilize the risk reversal strategy for hedging their position against profits and loss of the currencies. Basically, the losses which can occur from the currency trade. Now, what the importers expect is that the price of the foreign exchange must drop, or the local currency should become strong. If the price of the foreign exchange drops, then the importers import at a lower cost. On the other hand, the exporters expect that the foreign currency should become more expensive, because if the foreign currency becomes more expensive or the local currency becomes weak, then they earn more money from their exports. Now, to hedge, what the importer does is that he buys a call. So when he buys a call, his position is something like this. He will buy a call. Now we know that in a call option, his profits can be unlimited, whereas the losses will be at a certain limit. Now, if the currency becomes strong, which is against his wishes, then what the importer does is he gains from the options trade what he has made in the call option, and that hedges the position that he will lose from his normal trade which he will do for importing. He also sells a put option. Now what this does is that when the currency prices drop, which is the liking of the importer, he will make profits from his imports, but he will also suffer a loss from the put option what he has sold. But this loss will be offset by the profit what he will make from the uh, imports that he will make. So in end, what happens is that he ends up by trading his currencies in a particular range. That is, this is the range in which he will trade his currencies. Similarly, let's take the exporter's position. The exporter will buy a put. So in a put option, when he buys, it will be his position will be like this, where he will have unlimited profit from the put option, but he will have limited loss. Also, what he will do is that he will sell a call option. So the call option will give him a limited amount of profit, but he will give him unlimited amount of loss. What happens is that supposing the price of the currency drops, which is against the exporter's wishes, then he will make a profit from the option, which will offset for the loss from his exports, what he will make. So this is his position now. On the other hand, if the currency prices go up, he will be happy that his exports will earn more profits, but he will have a loss from the option, which will be offset by the profits which he will make. So in the end, what will happen is that he will also end up purchasing the currency at a particular range, which is to the suitability of the exporter. So in the end, you notice that Either the importer or exporter, by using the risk reversal strategy, will always make a purchase or sale of a currency, and that is what is the intention of the traders, what they want to do. Now let us discuss how the risk reversal strategy is set up. First, we will discuss from the importer's point of view. That is, when the importer trades, what does he do? So what the importer will do is that he will buy a call option for the currency at a particular strike price. In our example, he is buying the call option at 80 rupees at a premium of 1 rupees. And also he will make a sale of a put option. So the put option sale, this is important. The strike price of the put option should be less than the strike price of the buy of the call option. So the put option should be sold at a lesser price as compared to the buy of the call option. So here he is selling the put option at 78 rupees at a premium of 50 paise. Also, the premium from the buy call should be greater than the premium of the sell put. This is important. Now, in the range, what the importer will set normally is going to be very small. Maybe it is 50 paise or something like that. However, we are considering, for example, that the range is 2 rupees. So this is just an example, but normally in practice, the range will be very small because you would like to trade in a small range and he would like to be more predictable so that the price, what he gives for buying the currency is lesser. Nevertheless, what we see is that in either case, whether the prices rise or the prices fall, the importer will always purchase the currency in this case. The importer is interested in purchasing currency, so he will always make a purchase of the currency and he will always make a purchase of the currency within this range what he has set for himself. Now let us discuss the payoffs of the importer. So we know that the importer has bought a call at 80 rupees strike price at a premium of 1 rupee, and he has sold a put at 78 rupees strike price at a premium of 50 paise. So the net premium paid by the importer is that he pays 1 rupee for buying the call, and he gets, this is his negative, and he gets from the sale a premium of 50 paise. So his net premium what he is paying is 50 paise. That is, this is his payment what he will make from the premium. So this is the premium what he will be paying all the time. Now if you notice that, so his position from the call option is that this is the strike price at which he has purchased, this is the net premium what he is paying. So beyond this point he will start making profits at the point where it is the strike price of the call option, the buy call, minus the net premium plus the net premium paid, that is 1 rupee minus 50 paise, that will be his break even point. So this is his break even point. In our example, it is 80 rupees 50 paise because 80 rupees is the strike price plus the net premium paid is 50 paise. So here he will break even. If you notice that if we consider the market price at 80 rupees, then the importer will not exercise the buy call because the strike price is the same as the market price. So he will lose his 1 rupee what is the premium. However, the sale of the put option, that will also not be exercised because the buyer of the sale of the put option finds that the market value is less than the strike price, so he will not exercise it. So since he does not exercise it, our importer will have a profit of 50 paise from this sale put. Now because of this, his net position is that he loses 1 rupee, that is minus 1, and he gains 50 paise, that is 50 paise. So he makes a net loss of 50 paise, which is here, which is the net premium paid he will be losing. However, if the market price raises to 82 paise, 82 rupees, that is somewhere here, then what happens is that the importer will exercise the buy call because the market price is greater than the strike price. Market price here is greater than the strike price of the buy call. So from this he will get 82 rupees minus 80 rupees, that is the strike price, minus the 1 rupee premium paid. So he makes a profit of 1 rupee on this buy call. On the sale put, what will happen is that The sale put strike price is here, which is less than the market price. So the buyer of the sale put will not exercise his call. So our importer will get 50 paise premium from that sale put. So his net position is that he earns 1 rupee from the buy call and he earns 50 paise from the sale call, and his net profit is 1 rupee 50 paise. So you notice that he is making a profit as and when the market price is going up. Like we mentioned above, the importer's interest is that he has to buy currency. So if the market price goes up, he will be paying more for the currency. So he's the more he has to pay for the currency, he's offsetting his position by gaining from the options trade. Now let us study the importer's position when the market price drops. So now suppose the market price is here at the strike price of the sale put, that is at 78 rupees. If the market price is here, we notice that when the market price is 78 rupees, the importer will not exercise his buy call because the market price is here. His buy call strike price is greater than the market price, so he will not exercise. So instead, what he will do is that he will lose 1 rupee, which he will give to the seller of the uh, buy call. And then the sale put also will not be utilized because the strike price is the same as the market price. So our importer will gain 50 paise from this sale put. So his net position is that he loses 1 rupee and he gains 50 paise. So he makes a loss of 50 paise. So that is his position is here. Now supposing the market price falls further down, it comes to 77 rupees, that is somewhere here. In this case, what will happen is that the buy call will not be exercised, so our importer loses 1 rupee on that, but the sale put will be exercised. When the sale put is exercised, what happens is that the market price is 77 and the strike price is 78 and the premium earned is 50 paise. So he makes a loss of 50 paise here. So when he makes a loss of 50 paise, his net loss is 1 rupee 50 paise. That is 1 rupee from here and 50 paise from here. So notice that this position is somewhere here where he is making a loss. So notice that as the market price keeps going downwards, the loss of the importer keeps increasing. However, this loss is covered up from the fact that as the market price goes down, the importer is at a benefit position from his importing of goods because he's buying at a lesser price. So this is offsetting that. Now let us see the importer's position when the market price is between the two strike prices. That is the strike price of the buy call and the strike price of the sale put. So the market price is in this range. Then what will happen is that if the market price is here, it is less than the strike price of the buy call. So this buy call will not be executed. Also, this market price is greater than the strike price of the sale put, so the sale put also will not be executed. As a result, what will happen is that the importer, he will have to just forego the net premium what is for this particular risk reversal strategy trade what he has set up. So he will just forego the net premium which is this much, and he will buy the currency at the local market price. That is the intent. The importer basically intends that he wants to buy the currency in this range, and for that he is just setting up these hedges on both the sides so that in case the market price is not within this range, then he will have his positions covered. So as long as the market price is within this range, this is the importer's comfort. So he will buy the currency at this particular rate and he will give the premium whatever he has negotiated for setting up this strategy. Now let us study the exporter's trade. The exporter, he has to sell his currency. Now the exporter's intent is that he wants to sell the currency within a particular range. So this is his interest, that he wants to sell within this range and he wants to protect himself in case the prices drop below this particular point, because he wants the prices to increase. If the prices increase, the exporter is at a profit. So what the exporter does is he buys the put. So he will buy a put. So this is the put what he is buying. And in this case, we are taking example where he buys the put at 78 rupees at a premium of 1 rupee. And he also sells a call. Now, the important thing is that the strike price of the buy put should be less than the strike price of the sell call. So this is important. So in our example, the sell call is made at 80 rupees strike price and the premium for the sell call is 50 paise. So again, you notice that the net premium what he is paying is the difference between these two. For the buying, he will have to give 1 rupee, and for the sale of the call, he will earn 50 paise. So his net premium is 50 paise. What he will be paying. Now, the exporter, he will gain if the gain from the option if the price of the currency falls, and he will lose from the option if the price of the currency rises. But if the price of the currency rises, the exporter is at a advantageous position, and if the price of the currency falls, he is protected by the option. And if the price of the currency is within this range, this is what is his intention that he is setting up this whole risk reversal strategy for. Let us now study the payoff position of the exporter under different market circumstances. The first circumstance we understand is that when the market price is at rupees 77 under the example that we have set up, that is, he's buying a put at a strike price of 78 rupees, premium of 1 rupee, and he's selling a call at a strike price of 80 rupee, premium of 50 paise. So at 77 rupees, that is at this point when the market is here, then this position is that the the market price is less than the strike price of the sell call. So the sell call will not be exercised because the buyer of the sell call will not exercise the sell option, sell call, because the market price is lower than the strike price. So what our exporter will get is that the premium what is set up, that is this 50 paise premium for the sell call, he will get as a profit. The exporter, however, will exercise the buy put because the market price is less than the strike price of the buy put. So this will be exercised. From this position, he sees that the strike price is 78 rupees. The market price is 77 rupees and 1 rupee is the premium paid. So his net position is that he gets 0 rupees from this. So what happens is that he makes a profit of 50 paise and he doesn't earn anything from the buy put. So he makes a net profit of 50 paise here. So this is the position of the graph. So you notice that he is making a profit of 50 paise from this position. Supposing the market falls further at 75 rupees. So here what happens is that again the sell call will not be utilized. Our importer will get a profit of 50 paise, that is the premium. However, the buy put will be exercised. From the buy put, the position is that 78 rupees is the strike price, 75 rupees is the market price, 1 rupee is the premium paid, that will be minused. So he will get a net profit of 2 rupees. So his net position is that he gets 50 paisa from the sell call and 2 rupees from the buy put. So he makes a profit of 2 rupees 50 paise. So you notice that the profit keeps on increasing from the option as the market price goes down. This profit what he is making, it will offset the loss what he will suffer from the fall in the currency price, which he wants to sell. So as a formula, you can see here that the break-even price is that the strike price of the buy put minus the net premium paid, that will be the break-even point, that is here. Next, let's take the position when the market price rises. That is the market price we will study from here. It is beyond the strike price of the buy of the sell call. So when the market price raises from here, let's see. Suppose the market price is here, that is the strike price of the sell call. What happens is that the sell call will not be exercised because the market price and the strike price is the same. As a result, our exporter will earn a profit of 50 paise from this sell call not being exercised. Also, the buy put will not be exercised because the buy put strike price is less than the market price. So the buy put will not be exercised, and as a result, our investor will make a loss of 1 rupee. Now, the net position of that is that he will make a profit of 50 paise and make a loss of 1 rupee. So he makes a net loss of 50 paise. That is, he is here. Right. And then if the market price falls further, let's say at 81 rupees, Then what happens is that the market price is here. So the sell call will be exercised by the buyer of the call option. And as a result, we will have the position that the strike price is 80, the market price is 81, and he will get a premium of 50 paise from this, our exporter. As a result, he will suffer a loss of 50 paise. The exporter will not exercise his sell of his buy put, so he will make a loss of 1 rupee, that is the premium. So net position is that he will lose 50 paise from the sell call and he will lose 1 rupee from the buy put, and as a result his total loss will be rupees 150 per unit. So he will be somewhere here. So now notice that as the market price keeps increasing, the option will keep producing higher and higher loss for the exporter. However, this loss is offset by the fact that the exporter will be gaining from the selling of the currency at a higher market price. So that is what the intention was, and that is what is the exporter getting. Lastly, we see the position when the market price is between the two strike prices. So if the market price is between these two strike prices, what will happen is that supposing market price is here, this is less than the strike price of the call option. So the call option will not be utilized, and it is more than the strike price of the put option. So the put option will not be utilized. As a result, what will happen is that our exporter, he will gain the premium from the call option, and he will give the premium which he has bought for the put option, that is this much. So his net loss will be the net premium what he is paying, that is 50 paise in our example. However, by paying this 50 paise premium, net premium per unit, he is getting his intention, that is he wants to make a sale of his currency within this range. So that is what his intention was, and that is what he is getting. So he ultimately he makes his profit by the market operating within that particular range. That brings us to the end of this discussion. I hope you enjoyed it as much I enjoyed recording it. Thank you for listening.